Hello and welcome to Week 6, Passive Activities. At the end of this lesson, students should be able to describe the passive activity and at-risk rules. As soon as the tax code was created, taxpayers started trying to find ways to reduce or even avoid income taxes. One of the most popular ways that taxpayers have done this throughout the years is through direct participation programs. Direct participation programs are a way that taxpayers were able to generate losses to offset other income. But since 1986, those passive activities, those direct participation programs, are subject to the passive activity rules, which cover unearned income, and also the at-risk rules, which mean losses are limited to the amount economically at risk. So historically, direct participation programs have been formed as conduits, which means it is a business entity that is operating some sort of business, but rather than being taxed at the entity level, it is taxed as a conduit. And so taxable income, deductible expenses, tax credits, and gains and losses flow through to the owners without a layer of taxation at the entity or the business level. There are various ways that a conduit can operate. They can be formed as partnerships, S corporations. It could be a fractional ownership interest, such as joint tenants with right of survivorship or tenants in common. And they could also be what is sometimes called non-traditional business forms, although they're fairly traditional today, and that includes the limited liability company and the limited liability partnership. So there are some issues with direct participation programs, especially the older programs are going to be very illiquid. They weren't publicly traded, and it was difficult to find buyers and sellers. There typically is a substantial risk in the investment. So you put $10,000 into the investment, it is not at all assured that you will receive $10,000 at the end of that investment. And then certainly since 1986, your ability to use the tax benefits that the promoters of direct participation programs will tout has been severely limited. And so this is why you have to be very cautious when you're recommending direct participation programs for your clients. So let's talk about the most common vehicle for direct participation programs, and that's the partnership. In the old days, they were general partnerships. Now it's more commonly limited partnerships, master limited partnerships, or the LLCs and LLPs. So limited partnerships in some form are the most often selected for these direct participation programs, and they are typically referred to as tax shelters. In recent years, master limited partnerships have become more and more common, and they help alleviate some of that illiquidity risk, or the liquidity risk. So master limited partnerships are publicly traded on exchanges, but unlike other types of investments, common stocks, which are actually C corporations, which are not conduits, the master limited partnership is a conduit, and so it is taxed as a partnership, which means that your taxpayer owner is going to get the tax attributes passed out to them, and they will pay income taxes based on the attributes passed out to them. One of the lesser used forms of direct participation programs is the direct ownership, and as I mentioned, it could be the joint tenants with right of survivorship or the tenants in common. There are a couple of issues. These types of arrangements are illiquid. Who is interested in buying a 10% interest in tenants in common in a real estate, a piece of land, when they don't know the other 9 people? So it's pretty illiquid. It's a pretty inflexible arrangement. So the tenants in common or the joint tenants have to agree when there's going to be a change. And certainly there are personal liability issues, and that's why the limited liability companies and limited liability partnerships have become so popular, because they provide a level of protection that these direct ownership forms do not provide. So particularly with the partnerships, LLCs, and LLPs, there are some tax benefits. They include special allocations, accelerated deductions, tax credits, and leverage. So let's talk about those. Special allocations are a major benefit of partnership status because you're not allowed that in an S corporation. You can allocate income and expenses, gain and loss between partners, but there is a substantial economic effect requirement. So you cannot allocate all the income to the partners in the lower tax brackets and all the expenses to the partners in the higher income tax brackets. There has to be a business economic reason for doing the special allocation. Accelerated depreciation can provide tax deductions without the cash outlay. If you're using leverage and you borrow money to buy the equipment, there's no cash out of your operating funds, but you get that tax deduction. And we talked about the ability to write off equipment in a previous week. This tax advantage was much more pronounced before 1987 with the old depreciation rules, particularly with real estate. Now, as we approach almost 30 years after 1987, most of this real property is becoming fully depreciated, and so the benefits are not as pronounced, but we have learned how it is possible for some businesses to take advantage of accelerated depreciation and still get some of these benefits even today in a more limited way than they could in the past. So in the old days, tax credits were a very popular reason to invest in these tax shelters. There were tons of credits before 1986, and there were no limits on how investors could take advantage of those credits. So in the old days, an investor could put in $10,000, get lots of tax credits, and take them all off of their income taxes. And some investors were able to actually eliminate their income tax balances based on these tax credits from the tax shelters. Obviously, Congress found that this was abusive because it wasn't necessarily the working class people or the middle income people who were taking advantage of these investments. It was wealthy people who had advisors who could understand these laws before the internet, understand these laws and take advantage of it. So with the tax law of 1986, almost all of those credits were eliminated, not even an issue anymore. And for the few credits that are still available, they are severely limited. In fact, tax credits from passive activities are only allowed to reduce tax attributable to tax on passive activities. So very limited use of this existing credits. So let's take a look at a summary of tax shelters and the tax shelter laws. Tax shelters provided deductions for a taxpayer to reduce tax liability, and pre-1986, these were just basically tax avoidance schemes. Limited partnerships were the main culprits, the main tools, and many very high income taxpayers took advantage to the extent, as I mentioned, that it became abusive. Therefore, after 1986, all of those passive activity laws were changed, and now only passive losses can offset passive income with very few exceptions. So there are a few factors that affect the tax benefits for direct participation programs. These include substantial economic effect doctrine, the at-risk rules, alternative minimum tax, securities laws, and phantom income. So special allocation rules say that partnerships can specially allocate different types of income and deductions among the partners, but there has to be that substantial economic effect, as we mentioned, and in addition, if you achieve that substantial economic effect, the capital accounts have to properly reflect the fact that I, as one of the partners, received more than my fair share of deductions. That means my capital account is reduced even more than it normally would be. That has some ramifications, because if I'm a partner when the partnership liquidates and I have a negative capital balance, then I need to actually write a check to restore my capital account balance to zero. Also, if upon liquidation there actually are assets left over and assets to be distributed, my allocation, my share of that distribution, is going to be based on my capital account percentage. And so if I've taken extra deductions, my capital account percentage is lower relative to my other partners, and so my liquidating distribution is going to be lower as well. Let's talk a little bit about the at-risk rules. So the amount at risk is the amount, the total amount that the investor could actually use, and it's comprised of a couple of items. It's definitely the cash invested. It's also the adjusted basis of any other property that I might contribute to the activity. It also includes borrowing for which I am personally liable or I have pledged collateral. So in either of these instances, if the business cannot pay that loan back, then I personally have to write a check, or I personally have to relinquish my collateral in satisfaction of that loan. And in either of those instances, I am economically at risk. In addition, any income that I receive from the business, income that I pay tax on, that increases my basis, my at-risk basis. Any losses that are allocated to me decrease my basis. And then any withdrawals, so any distributions I get from the partnership, are going to decrease my amount at risk. In addition to those items, there is another type of loan that gives investors in real estate additional at-risk basis, and it's called the qualified non-recourse loans. Qualified non-recourse loans are secured by the real estate. Nobody is personally liable, but they receive at-risk basis because if the if the business defaults on the loan, the real estate will secure the loan. So there's some economic at risk there because you're losing the property as an owner. This qualified non-recourse financing may not be convertible to an equity interest, and it has to be provided by an unrelated party who regularly engages in lending money, so basically a bank, not one of the other partners. Now, the attractiveness of tax shelters, both in the old days and now, is the fact that the tax advantages are front-end loaded. But when tax advantages are front-loaded, that means that there's the potential for the partnership to burn out. So at some point in time, the deductions, which are more than your cash taxable income, are going to flip. And so you'll have fewer deductions than your cash taxable income, and that becomes phantom income. So you have taxable income without the cash flow to support it. Now, it's easy to say, well, I will just have my client invest in the tax shelter in the early years, and then I'll get rid of it before it flips and generates phantom income. But in today's modern information era, it is fairly easy for anyone that does any sort of due diligence to see when that's going to flip. And so the value of a burnt out tax shelter is almost nothing. So you have to be very careful when advising your clients about tax shelters to let them know that they need to be prepared for that flip if they cannot get rid of that tax shelter. So we've talked a little bit about at-risk rules. Once we have determined that there is an amount at risk and the losses are allowed for at-risk purposes, then we need to turn our attention to passive activities and follow the passive activity rules. So passive activity income is obviously derived from a passive activity, and passive activities are defined in terms of material participation. So are you spending time in the business? Are you managing the business? Or is this just really an investment that you are passively a part of? There are several tests from the IRS to determine material participation, and they involve time spent and actual activities provided to those entities. So if the taxpayer has a regular, continuous, and substantial involvement in the activity, they are deemed to be materially participating and not passive. But if they don't, they're deemed to be passive, and there's a deduction on a limit on the deductions that they can take when a taxpayer is not a material participant in the activity. So the passive activity rules affect most taxpayers. They affect individuals, estates, trusts, closely held corporations, personal service corporations, but you'll see they do not affect partnerships or S corporations. There are special rules for real estate. Generally speaking, real estate is a passive activity. However, Congress realized that there are a lot of individual taxpayers who dabble in real estate. They have 1 or 2 rental properties, and consequently they've provided a little bit of relief. So some taxpayers can avoid passive loss limitations on rental real estate. They have to be the active manager, and I don't mean active in the sense of active activity rules, but they need to be the one that's managing the property. If the taxpayer is managing the property and modified adjusted gross income is under $100,000, then that taxpayer is allowed to offset up to $25,000 of non-passive income with those passive losses. Once a taxpayer's modified AGI gets over $100,000, the $25,000 starts to phase out, and when a taxpayer's modified AGI is $150,000, there is no rental real estate activity exception. And so all of those passive losses would be suspended until income came down and they were able to take some of those losses, or until the activity was disposed of. There's another type of real estate exception, and that's for real estate professionals. Real estate professionals can deduct losses from unlimited losses from real estate trade if they spend more than 50% of their personal services during the tax year, which means if you have a full-time job, by definition, it's not possible to be a real estate professional also. But if you're spending more than 50% of your personal service time in real estate, and that also is more than 750 hours in a given year, then you can be considered a real estate professional. It doesn't matter what your other income is. You're allowed to take all of those losses as active losses. Oil and gas properties are one opportunity for taxpayers to take advantage of what we would consider to be a tax shelter. It has to be a working interest in oil and gas, though, so it can't be a limited partnership or a royalty interest. But if your client purchases a working interest in an oil or gas activity, then they treat that as active. It's actually reported on a Schedule C. The losses are unlimited for passive activity. They are limited by the amount at risk, so the amount invested. But it is a way for taxpayers who need a tax deduction to contribute $10,000 to the activity in a year, and potentially, because of depletion and depreciation, potentially could get almost a $10,000 write-off in a given year. Now, there is substantial risk with oil and gas working interests. You buy a well, and if it does not produce, you are truly out that money. If it does produce, then you report that income. It is going to be self-employment income, though, if you do end up investing in a winning well and having profits come out of that. So that's the risk, a couple of risks with your oil and gas working interests. Publicly traded limited partnerships adds just one more layer to these passive activity rules. So generally speaking, if you have passive losses, they can offset other passive income from other activities. However, if you have a publicly traded partnership, limited partnership with a loss, it cannot offset any income except for income from that same partnership, which means if you have a loss in a given year, you must carry it forward until that same investment has income, in which case you can use the carryover losses to offset that income. So that's another reason why publicly traded limited partnerships are not very attractive for tax purposes, even though, again, their promoters will say, oh, you can have these tax deductions. In effect, you really can't. In practice, you really can't. So how would you know if your client is invested in a publicly traded limited partnership? Well, on that K-1 form that they receive at the end of the year, there's actually a box that can be checked if there are a tax shelter or a publicly traded limited partnership. And if the box is checked and there's a number, a registration number, then you know it's a publicly traded limited partnership, and those losses are severely restricted. So in a previous lesson, we talked a little bit about renting out a residence or a vacation home, but let's touch on that again. If you rent out your residence for less than 14 days, you get a free pass. You don't need to report anything on your tax return. But if you rent your residence out for more than 14 days and your personal use is greater than the greater of 14 days or 10% of those total rental days, then you prorate your expenses. You report the income, you prorate your expenses to the point where your profit from the activity becomes zero. So you cannot have a loss on a rental property when these parameters are met. However, if you rented your personal residence out for more than 14 days and your personal use does not exceed the greater of 14 days or 10% of the rental days, then you report all your income, you allocate your expenses between personal use and rental, but you are allowed to have a passive rental loss, and so you would follow the passive rules. So to summarize what we've learned in this lesson, at-risk and passive activity rules have limited taxpayers' ability to utilize tax shelters. As advisors, it is so important for us to understand the true tax implications of the investments that we recommend to our clients, and I hope that after listening to this lesson, you have a little bit better understanding of those ramifications.